All right, first off, happy Thanksgiving to everybody. I'm going to do a public video just for Thanksgiving. I'm going to show you what I think is going on, what's driving some of the moves, especially in the stock market. I think it will also drive a move in gold. So on November 1st, the last FOMC meeting, the Fed failed to hike rates again, and the market at that point knew that the rate hiking cycle is done. Any more threats from the Fed are just going to be bluffs. They're not going to hike. The futures market priced out all through next year has literally zero chance of any rate hikes. And by mid-year, it starts to price in rate cuts. So I think I noted this in one of my previous public videos that this intermediate cycle in bonds, it was left translated, which means that it would almost certainly break below this pivot and probably this pivot, but it was really long in the tooth, so we were unlikely to get a sustained break of these support zones. By that I mean it wouldn't break it and just run. Price would probably come back up, more of a stair-stepping process. And you can see the problem here with this long-term chart. Price is stretched way too far below the 200-week moving average. So with the Fed done hiking rates, we're going to get a bounce here. I suspect this may even turn out to be a right-translated cycle that rallies more weeks going up than it does going down, and that would mean that the next intermediate cycle low is probably going to hold above this pivot right here. Now, I do think we're in a long-term secular bear market for bonds and a bull market for interest rates, but we're due for a pretty good breather. We've just stretched the rubber band way too far below the long-term mean here, and we're going to have a counter trend, a durable counter trend move to get everybody convinced that interest rates have topped and everybody on the wrong side of the boat. And I think that's what we're set up for here. I think we're going to have a pretty good rally, might even come up to break this pivot here, although I think probably a more likely scenario is not a break of this pivot, but just a long, drawn-out, grinding rally that probably comes up a little short, but eats up a lot of time and allows this moving average some months to catch up to price. So this is one of the drivers right here, is that the Fed is done with the rate hiking cycle. The market recognizes it now, and that's what's driving the rally for sure in stock. Well, it's one of the drivers of what is driving the rally in stocks. Now let me show you the next one. All right, this is the dollar. This semi-parabolic move, I think, was the end of the secular bull market in the dollar. We got our first leg down, and then we got the top back here again on the last FOMC meeting, where the Fed confirmed that they're not going to, where the market recognized that they were bluffing. There's not going to be any more interest rate hikes. That put a top in the dollar, and this intermediate cycle has topped. It topped on week 11, and that's kind of right in between left and right translated. I'm of the opinion, since I think this is a secular bull market top, then I think we're in a secular bear market, which means we should make lower lows, lower highs and lower lows. So I'm of the opinion that this intermediate decline, we're in the declining phase of this overall intermediate cycle. This is one intermediate cycle right here, and it's topped. So the advancing phase topped right here, and then we got the FOMC meeting. The Fed confirmed that they were not going to raise rates anymore. The market, the dollar started to sell off, and I'm of the opinion that we're probably going to make a lower low, but because we've chewed up a lot of this intermediate cycle, 11 weeks, then we've probably are going to bottom somewhere around week 22 to 25. And so I don't think, just like bonds, I don't think we're going to get a sustained breakdown below this. I think it'll be a temporary breakdown, and then price will bounce back up into the this consolidation zone here. So my feeling is over the next 10 weeks or so, the dollar may come down and tag this 200-week moving average. And I think there's a very strong possibility that that's going to act as support, and then we'll get another bounce, another very convincing bounce. And it won't be until sometime next year that price will drop below this 200-week moving average. But this is another driver of what is driving moves in other asset classes. So now let me go to stocks. All right, so we've got a lot of liquidity coming into the market. The Fed would like to focus that liquidity in the stock market, real estate markets, those kind of things. They would prefer to keep it out of the commodity markets and try and keep inflation under control. I think they're going to fail, but as of the initial move anyway, the liquidity has flooded back into the stock market with a vengeance. And I got people in on November 1st right here on the FOMC meeting, and we're holding our position. I think we still have quite a long ways to go yet. Of course, there will be corrections along the way. Pretty much impossible to guess exactly when those corrections are going to occur. We may get a temporary one. I was kind of expecting a temporary one at this resistance, but it kind of looks like price wants to go through that resistance. So it may be that we have to get up here and test the intermediate high before we get our drop into a half cycle low. Those don't tend to last very long, usually. Anywhere from 2 to 5 days, and then the rally resumes. So it is entirely possible that the stock market could test the all-time highs before this first daily cycle tops. Now, the likely spot for a top would be December 13th. That's the next Fed meeting. But this is what is driving this manic rally in the stock market, is that the bond market is selling off. Interest rates the bond market is also rallying, and interest rates are dropping, and the dollar is starting to collapse in the declining phase of that intermediate cycle. And that liquidity has to find something to land on. And it's landing in stocks. Now let me go to gold. Actually, before I go to gold, let me show you first here. This is the FOMC meeting right here on November 1st, and this started the collapse in the dollar. So this is, stocks bottomed and started to rally a couple days before this. They started to sniff this out, but basically this is what's driving most things. And it's going to drive inflation too. The Fed is not going to be able to stop inflation. So now let's go to gold. All right. I posted multiple videos about this, and the bloodbath phase in gold. They tend to last 5 to 7 days. This one lasted 7 days. This is where people were telling me I was wrong. Gold was going to 1,600, 1,400, blah, blah, blah. The same thing that happens at every one of these bottoms. But if you know what to look for and you recognize the bloodbath phase, you know that it doesn't last very long, and you got to be prepared for the market to turn and go in the other direction. And then, of course, we got the whole debacle in Israel, and this drove a very powerful rally in gold. And then on November 1st, this is when the dollar topped, and you got to hand it to the banking cartel. They did one heck of a job beating gold back from that 2,000 level, despite the dollar dropping. But they're not going to be able to hold this suppression. And we're seeing it here. They did manage to keep gold suppressed below 2,000, and they did manage to manufacture a move into a daily cycle low, even as the dollar was dropping. But they have not been able to hold that, and gold is bouncing again, and we're again testing this 2,000, and I'm on record that they are not going to be able to hold this too much longer below 2,000. Gold is going to break out above this. It's going to come up here to test the all-time highs, which are at about 2090. I'm pretty sure it's going to do it during the second daily cycle, despite, however much suppression and manipulation they try and throw at the gold market. It's just, they're not going to be able to hold this. And we're going to get this, we're going to get a breakout above 2,000 as the dollar continues to collapse. But then we're going to fight this war all over again at 2090. So the metals market is just going to be a bit difficult here. We're getting these big rallies and then serious suppression at these resistance zones. Obviously at 2,000, I warned everybody this was going to happen. I'm going to warn you now, it's going to happen again here at 2090. So this is going to be a difficult market still. Gold has to completely break the suppression and get a breakout above 2090 before we can really start to get some strongly trending moves and something that doesn't whipsaw people quite a bit. But this is also, the collapsing dollar, this is also going to drive the move in gold. And then finally, I've seen a lot of people, they're trying to rationalize this move in oil as oil is starting to sniff out a recession. I don't think we're ready for a recession yet. I think it's maybe going to be middle or end of next year before we really get into a recession. So this is not anticipating recession. This is just a intermediate degree profit taking event. So let me widen this chart and I'll show you here. All right, so once this really difficult sideways churn gave way to a strong trending move, then that move continued until it hit this resistance zone. So this was a multi-month move. It was ripe for a profit-taking event. This resistance zone stopped the move, and the longer a move like this takes, and the more bullish sentiment it builds, generally the longer it takes to wipe out that sentiment and set the stage for the next rally, and that's what's happened. So this is not predicting any kind of economic event or anything. This is just a profit-taking event. So the sellers came in right here, and then stops started to get hit. We had a little bounce, but it couldn't. Weren't enough buyers yet. The market hadn't wiped out enough of the bullish sentiment. With this first little leg down to build the fuel for another move and a breakout. So this rally failed. Again, price started to go down, more and more stops hit. So that's all this was. It's just a profit-taking event. It's probably about run out of steam. I think we're about ready to start the next rally, and the collapsing dollar is going to help this, just like it's going to help gold. So oil will still remain difficult because I think we're building a cup and handle pattern, and the right side of this pattern is probably going to be kind of a gradual back and forth grind, kind of how the left side came down. The right side's probably going to more or less mirror how the left side of this pattern formed. So I don't know that we're going to get any massive move. Now this could change if everything in the Middle East really starts to go to shit. And the war starts to expand in the Middle East, well, then this could just take off. But for now, I'm expecting kind of a gradual move up in oil. But I think we're probably just about done with this intermediate correction in oil. And I think that collapsing dollar is going to help to push oil higher as well. So the Fed and the banking cartel is going to continue to try and manipulate gold. They want to keep they want the stock market to go up, because you can't have a recession if the stock market is going up. But they don't want commodity inflation to come back. But I think it's hoping in vain. I don't think they're going to be able to. They're not going to be able to hold that suppression in gold very much longer. And I think oil is just about done, and it's going to start to move higher as well. And then at some point, stocks are going to hit a resistance zone where you just don't have a whole lot of buyers left. And so more and more of that liquidity is going to go into things that aren't or are undervalued. So let me show you the long-term chart of stocks and where I think that where liquidity is going to start to leak out. All right, this is a weekly chart. This is the 200-week moving average. You can see price was just stretched obscenely far above this 200-week moving average. The Fed started to hike interest rates, and that was the excuse for a regression event. Again, a profit-taking event, not some major change in the fundamentals, not a recession or anything like that, but a regression event to come back down to the moving average. I think it would have been better if price could have dropped below the average, but it didn't. So I think stocks are probably going to be stuck going sideways. So my guess is this intermediate cycle is probably going to come up to test these all-time highs. Might even get a marginal breakout, but I don't think we're going to get a sustained breakout, just like we couldn't get a sustained breakdown in the bond market. And the reason is this 4-year cycle is getting very mature. The 4-year cycle, though, is going to be due in spring or summer of 2024, so we're running out of time. Breakouts that occur late in a cycle don't generally produce sustained moves. So we are just running out of time for a breakout and a sustained move higher. And I'm going to say if we do get up here, which I think is probably likely, by January, and we do get up here and we test these all-time highs, and if we get a marginal breakout, you want to be a seller right there. You do not want to bet that we're just taking off and we're going to the moon at that point. And again, price will be stretched too far above this 200-week moving average. And then we'll have that 4-year cycle low that's coming due that's probably going to pull price back down. My guess is that we will probably at least test these October of 22 lows. We might even go below it. So basically, when we got stretched this far above the moving average, it meant one of two things. We either had to go really far below it, or we're going to have to go sideways. We're not going to get a sustained breakout for several years. And that looks like what's probably going to play out here. Is we're probably going to test it. Smart money is going to sell. The smart money will probably try and manufacture a small breakout so that the retail traders and hedge funds will buy that breakout. But you don't want to be buying breakouts that occur late in a cycle, because they almost never produce a sustained move. I think this time will be the same. Any breakout here in like January or early February, I think you need to be a seller of it, and then get on the sidelines until we get our move into our 4-year cycle low. So the collapse in the dollar, a decline in interest rates, that is what is driving this move. It is eventually, when stocks get up here and start to get too stretched, liquidity is going to start to come out of the stock market, and it's going to look for something else to land in, and that's going to be the commodity markets, which I think will come along for the ride. But once the stock market tops, then more and more of that liquidity is going to flow into the commodity markets, and we're going to have another surge in inflation. So right now, we want to ride the move in stocks, and we want to start getting positioned in commodities. But once the stock market gets up here and starts to the liquidity starts to leave an overvalued stock market and look for something else to buy, I think that's when the commodity markets really start to take off.